Welcome back to another GT Homes exclusive. One question we often hear is, how do I know which mortgage is right for me? Great question. Before we get into the types of mortgages, let's start with what a mortgage is. A mortgage is a type of loan used to purchase a home, land, or any other form of real estate. The price of a home is often greater than what a single person or household can save. Instead, many investors or home buyers put down a deposit of approximately anywhere from 5% to 20% of the home's purchase price and get a mortgage for the remaining amount. When getting a mortgage, the borrower agrees to make regular payments to the lender over a set period. Until the loan is paid in full, it will gain interest, which must be paid in full in addition to the original amount. Mortgages are considered a secured loan because if you fail to comply with the terms of your contract, the lender is allowed to repossess your property as collateral. Who can give out mortgages? Potential home buyers have many options available to them when it comes to choosing where to get a mortgage and what type of mortgage they need. Mortgage lenders are organizations that have the ability to lend you money directly. Examples of mortgage lenders include banks, credit unions, mortgage companies, insurance companies, trust companies, and loan companies. Mortgage brokers can also provide you with a mortgage. However, rather than lending you money directly, they will help you pick a lender and arrange the contract between you and the lender. You might be wondering what you should consider when applying for a mortgage. When shopping around for a mortgage, you will be presented with many options, which can sometimes feel a bit overwhelming. It's vital for you as an investor to understand the elements of a mortgage so that you can choose the right one for you. The key elements of any mortgage include the principal amount, your term, your amortization period, and the payment frequency. The principal amount, which is the total amount you borrow from your lender to purchase the property, it includes the home's purchase price minus your down payment. It can also include mandatory insurance if your down payment is less than 20% or if your lender calls for it. Your term means the time your mortgage contract is in effect. It determines your interest rate and payment schedule. A mortgage term can last anywhere from several months to 5 years or more. Buyers will often need several terms before they're able to pay off their mortgage in full. Amortization is the time needed to repay your mortgage in full. The longer the amortization period, the smaller the regular payments. However, it's important to remember the longer you spend paying off your mortgage, the more interest you will have to pay. The average Canadian takes 20 to 25 years to pay off their mortgage. Payment frequency relates to the frequency at which you make your mortgage payments. People typically choose to make monthly mortgage payments. However, there are other payment frequency options available, including semi-monthly, bi-weekly, and weekly payments. One of the biggest factors to take into consideration when applying for a mortgage is interest rates. Higher interest rates mean higher mortgage payments. When your term is up for renewal, you are essentially renegotiating your interest rate, which can make future mortgage payments higher or lower. The interest rate your lender offers depends on the length of your mortgage term, the type of interest rate you pick, the current interest rate offered by your lender, your credit history, whether you're self-employed, your eligibility for discounted interest rates, and the specific lender. There are several interest rate options to choose from. Fixed interest rates remain the same throughout the term, ensuring that your payments remain stable for the term's duration. Variable interest rates fluctuate throughout the term and are usually lower than fixed interest rates. When choosing a fixed payment with a variable interest rate, you will keep your regular payments the same while your interest rate changes. You can also choose an adjustable payment option with a variable rate, which would change your regular payment amount as the rate changes. A hybrid or combination mortgage features both fixed and variable interest rates. The fixed part of the mortgage will give you some protection against the interest rate increasing, while the variable part will give you partial protection if the rate goes down. The two parts may have different terms, making it harder to transfer such mortgages to other lenders. Now that you know what a mortgage is, let's get into the types of mortgages you can apply for. Open mortgages are a flexible form of mortgage that allows you to pay extra on top of your regular payments and pay off your loan sooner. This is a good option for you if you plan to pay off your mortgage in the near future, you plan to sell your property soon, you want to set aside additional money towards your mortgage every now and then. Closed mortgages usually have a lower rate than open mortgages of a similar length. However, it's important to remember that this type of mortgage will often restrict the amount of additional money you can pay towards your mortgage each year. You might choose this option if you expect to keep your property until the end of your term, your lender's prepayment privileges are flexible enough to allow for any extra payments you want to make. If you plan to sell your home and buy another, a portable mortgage may be your best bet. It will let you transfer your mortgage balance, terms and conditions, and interest rate to your new home. You may want to consider this option if you're happy with the terms of your current mortgage, you're looking to avoid paying a fine for breaking your mortgage contract early. Assumable mortgages allow you to receive someone else's mortgage and associated property. A key feature of this option is that when a mortgage changes hands, its terms must stay the same. It would be a good idea to take on an assumable mortgage if you're a buyer and interest rates have gone up since you initially obtained your mortgage, you are a seller looking to move into a less expensive property and want to avoid paying prepayment fees as you have several years left on your term. Seeing that you're now a mortgage expert, let's dive into how to apply for one. Mortgage lenders approve potential borrowers using a rigorous application process. Only those likely to pay off their loan over time get approved. Your credit score also plays a major role. If approved, these factors will also affect the interest rate on your mortgage, as those who are seen to be risky clients will be giving a higher interest rate. Many home buyers choose to apply for a mortgage while they're still shopping around for a home, as this allows them to show sellers that they have the money to back up their offer. This process is called a mortgage pre-approval. When pre-approved, your mortgage lender will let you know the largest mortgage amount you're eligible for, roughly how much you can expect your mortgage payments to be, a locked-in interest rate between 60 to 130 days for resale units, or 36 months to 60 months for pre-construction units, depending on the lender. To get pre-approved, your lender will ask you for your personal information, various documents, and will likely run a credit check. It is crucial to ask your lender or mortgage broker about each type of option available to you. At GTA Homes, our team of planning agents will help you understand the buying process from the moment you decide to buy until you have closed the deal and received your mortgage. Thank you for watching another GTA Homes exclusive. Remember to subscribe and to visit us at gta-homes.com.